Episode 5 of Morning Minutes, hoping to come at you with some simple, smart advice. So today what I want to talk to you guys about is lump sum investing versus dollar cost averaging. This is actually a request from one of my fans. I don't know if I could call him a fan, if Ben's a fan. Hopefully he is. But this came as a request from one of the comments. So I thought I'd do a little quick, something different, little video for you guys. Let me just move my ugly mug there. I'll leave myself there. Okay. So dollar cost averaging versus lump sum investing, okay? Which is better? All right, so I'm going to go through a hypothetical scenario here. Basically, we've received $1 million somehow, windfall, won the lottery, whatever. And I guess the question is, should I invest this immediately, all in one shot, or should I break it up, equally, and invest it over a monthly basis, okay? So just some assumptions specific to this scenario. I'm assuming the rate of return is constant. I've chose 12% as an example. Again, that's pulled out of thin air. It's an arbitrary number. It breaks 12 divides evenly into on a monthly basis. So that's why I chose it. In the grand scheme of things, it's just a plug. It means it's an arbitrary number. Okay. We're going to ignore inflation. We're going to ignore taxes and inflation in this scenario. Obviously, if there's growth and there's income or dividends or something like that, that may be taxable in the in the year you receive it. We're just in this scenario that stuff does not exist. All right. Same goes for inflation. Okay. Then that's just done to keep things simple. Okay. So here in our lump sum scenario, so I've just simply taken, $1 million, and I take 1% or 12% compounded monthly. So, we're earning 1% on our money every year. Again, just nice or every month. And at the end of the year, at the end of our period, we will have $1.126 million dollars at the end of it. Okay. So moving over to the lump sum amount, I simply took $1 million divided by 12 months, and that broke evenly into 83,333 and some change. I ignored the decimal points because in the grand scheme of things, it doesn't make that much of a difference, a material difference. And that's what I did. So I took 83,000 times 1%, and that gave us our growth. Then in the next month, I took our previous month balance, added another 83,000, added the dollar cost averaging to it, and multiplied it by 1%, so on and so forth until the 12 month where we're fully invested, and our full $1 million has been invested, and we would end up with 1,067,000 and some change. Okay, so as you can see, in this case, or in this scenario, the lump sum investing option, if you want to call it, comes out ahead by just under $60,000. Okay, so let's look at why that is, and let's look at this objectively and intuitively. Why this makes sense. So, in the lump sum scenario, we're fully invested from day one. Okay, that $1 million is invested from day one until to the end of that period. Okay, so if we look at our weighted average invested per month, on any given point or on any given month, we have just over $1 million invested due to growth and all of that stuff. Compare that to the dollar cost average version right over here. We've got $403,000 invested. Weighted average on any given month. And again, that makes sense intuitively because in month one, we only have, $84,000 invested compared to, $1 million in the lump sum. The next month, we is our next step into the contribution. Well, now we only have about 170,000 invested relative to, just over $1 million, and so on and so forth. So it intuitively makes sense that because my weighted average, units at risk throughout this period is significantly less, right? So just from an absolute perspective, I should be compensated less for it because I've taken on less risk effectively, right? I've had more units at risk in the lump sum version. Therefore, I'm compensated more, in absolute terms, because I've taken on more risk. And in the dollar cost average version, the opposite is true, right? I haven't taken as much risk throughout that period, so I'm not going to get as much. Again, assuming all things equal in these scenarios. Now, if we flip the switch and turn that into a negative 12%, let's look what happens. Okay, well, our weighted average invested throughout that period in the lump sum version, in the lump sum scenario, is about 950,000. Relative to the dollar cost average is 374. Again, the dollar cost average scenario, our average units at risk is significantly less. That being said, we've lost less money in the dollar cost averaging scenario. And again, this makes sense intuitively because in the lump sum version, we're taking on more risk on any given month throughout that period. Okay, so which is better? Again, if we're looking at it from a purely objective standpoint, there's no real right or wrong answer to it. It all depends on what, I guess, you're comfortable with. But just from the pure maths, again, and keeping it, true to this scenario, the lump sum investing situation comes out ahead. Okay. Compared to the dollar cost averaging. And how I like to think of dollar cost averaging is it's like think about it as jumping into a hot tub almost. Like me personally, I can't jump into a hot tub. I have to first get my feet wet and let my feet adjust to the temperature. Then I'll go, just below the knees and let my body adjust to the temperature. Then I'll go waist down and, let that adjust, and so on and so forth. So it's a systematic and regular way of getting into something without it being so uncomfortable that I would have to jump out or something like that. Okay. So, which is better? It is context specific. It depends on the client. It depends on what you're trying to achieve. It depends what your risk appetite is. It depends what your time horizon is. It depends on a lot of things. I know that might not be a very satisfying answer. It depends, but it really does. It does depend. Yeah, I think that's all I had for this example. I hope you guys enjoyed that. If you'd like to see some more of this stuff, let me know. I'd love to do them, and hope you guys enjoyed it. You guys have yourself a wonderful day. All right, see you guys later.